Welcome to the deep dive. Today we're doing a high-speed sprint. We're looking at just the last 24 hours of market movement.
Just the critical stuff.
Exactly. We've got announcements, SEC filings, analyst calls. I think we're tracking over 30 tickers here. Fintech, streaming, health tech, you name it.
And it is Monday morning, November 18th, 2025. And you're right, it was, quiet for a lot of companies after the earnings rush.
But not for everyone.
No, not at all. The news that did break was really polarized. On one hand, you had these very technical, almost procedural corporate actions.
Let's stock splits.
Stock splits, massive buybacks. And on the other hand, you had some, truly surprising market reactions. So our job today is to cut through that noise and give you the so what of it all.
Okay, let's unpack this. And we have to start with media, right? Because the biggest technical event of the whole quarter just happened with Netflix.
That was the defining action, for sure. The Netflix 10-for-1 stock split. It officially became effective yesterday, November 17th.
So if you were a Netflix shareholder, ticker NFLX, your stock was trading near, $1,500 last week?
Around there.
You woke up this morning, and for every one share you owned, you now have 9 more, and the price is adjusted way down to about $150.
Right.
So my question is, why does a move like this, which is purely administrative and doesn't change the company's value at all, become such big news?
It's all about accessibility and psychology. You're right. Your investment value is exactly the same technically.
Mm-hmm.
But from a behavioral finance view, that lower price tag, it's just attractive. $150 feels accessible.
To a retail trader, yeah.
You're a retail trader who might have been, scared off by a 4-figure stock price. It just broadens the potential investor base. It helps liquidity.
And it sends all the analysts back to their spreadsheets to do some basic math.
Exactly. We saw that with Canaccord Genuity. They kept their buy rating, but they had to adjust their price target from $1,525 down to $152.50.
It's just them showing their work, really, confirming it's a technicality.
It is. But beyond the split, you have to look at their operations. Netflix is crushing it there.
The ad-supported tier?
The ad-supported tier just passed 190 million monthly active viewers. That is huge. It completely validates their pivot away from being a pure subscription play.
Which brings us to Disney. Ticker DIS. The whole strategy there, under Bob Iger, it's always been about one thing: intellectual property.
Oh, absolutely. The dominance of Pixar, Marvel, Lucasfilm, now the Fox assets. They have the strongest content library in the world, period.
And yet there's this challenge, the street pointed it out. Even with all that powerful IP, it seems like they can't fix the whole industry by themselves.
They can't. And the industry problem is the overall movie theater attendance. It's just not back to pre-pandemic levels. It's struggling.
So Disney has the best product, but it's in a distribution system that's still kind of broken.
That's a perfect way to put it. It forces them to keep betting everything on their own streaming platform, on Disney Plus, to get their returns.
Right, which puts a ton of pressure on hitting those profitability goals for streaming.
A ton.
Okay, last one in media. News Corp. NWS? They filed an 8K.
They did. And they basically used it to reaffirm their commitment to the existing $1 billion share repurchase program.
That feels routine, but is it? What's the signal they're sending?
Well, an 8K is usually for unscheduled material events. So when a company uses it just to confirm something that's already in place.
Especially something as big as $1 billion buyback.
It's a massive confidence signal. They're telling the market, hey, just so you know, nothing's changed. We still have the cash. We're still buying our stock back. Our long-term health is solid. It just removes any doubt.
Okay, so that takes us from, stable corporate moves into fintech and crypto, and here things got volatile and painful.
Yeah, that's the word for it. Painful. Robinhood, Hood, and Coinbase, Coin9, both just got battered.
By what? Just broad crypto sentiment?
Pretty much. Coinbase, Coin9 was down almost 9%, 8.74% to be exact.
Wow.
And Robinhood was right behind it, down over 8%. It's just a stark reminder of how tightly these stocks are linked to the day-to-day crypto market.
Even when their businesses are more than just crypto.
Exactly. And that's the big contradiction with Robinhood, isn't it?
It is, because they actually announced fantastic October data. Their DARTs, the daily average revenue trades, were up year over year.
For everything. Stocks, options, and crypto.
They're executing really well, but the stock gets hammered anyway.
It's a classic case of sector sentiment just overpowering a company's actual performance. The market sees crypto dip and just sells everything with the word crypto attached to it.
But it seems like Robinhood's looking beyond that. NASDAQ reported they're trying to get a jump on the competition in Europe.
Yeah, by launching tokenized U.S. stocks in the EU. That is a really bold strategic play.
Why bold?
Because if they can pull it off, if they can establish that beachhead in the EU before anyone else, it opens up a massive new growth lane for them. It makes them less reliant on the super competitive U.S. market.
Okay, now this is where the fintech story gets, I think, really interesting. The institutional conviction behind Affirm, AFRM.
This was wild. It came from a 13F filing from the hedge fund Abdeel Capital Advisors.
What did it show?
It showed that Affirm, the buy now, pay later company, represents a staggering 21.2% of their total assets under management.
Wait, hold on. 21% of their entire portfolio in one stock.
Over $70 million.
That seems, I mean, is that conviction or is that just incredibly risky?
It's pure conviction. For a fund manager to concentrate that heavily, I mean, anything over 10% is considered a big bet. They're not playing for next quarter's earnings.
They're playing the long game.
The very long game. They're betting that Affirm is going to be the ultimate winner in a complete reinvention of consumer credit. They see buy now, pay later as a fundamental disruptor to the entire credit card industry.
So they're willing to ride out any short-term swings.
Absolutely. They think the potential upside is just that massive.
Okay, so huge vote of confidence there. Elsewhere, what about Block, ticker SQ?
Some analyst news just ahead of their big investor day, which is actually happening today. TD Cowen maintained its buy rating and a $91 price target.
So that sort of sets a positive tone for the event.
It does. Now investors are going to be looking to management to, validate that optimism.
And the rest of the fintechs. SoFi, Upstart, PayPal.
Pretty much quiet. The only thing worth noting is SoFi launched consumer crypto trading about 6 days ago, which, again, just shows that everyone's trying to bridge that gap between traditional and digital finance.
That theme market sentiment versus actual strength brings us to what I think is the biggest paradox we saw in the last 24 hours.
Oh, sure.
We saw companies with genuinely great numbers get absolutely punished. Let's start with Duolingo, D-U-O-L.
Okay, so Duolingo stock hit a fresh 52-week low. It traded at $181.49.
And when you hear 52-week low, you automatically assume the worst, right? Revenue's down, products failing, something is wrong.
But it's the complete opposite. You look at the data from Investing Pro. Their revenue growth is a super robust 39.9%.
That's fantastic.
Their gross margin is 72%. Their overall financial health score is literally rated great. Their product is amazing.
So what on earth is going on? Why the disconnect?
It is a total market disconnect, and it's driven entirely by one thing: valuation anxiety.
Meaning the market thinks it's just too expensive?
Exactly. It's like a shopper who loves a luxury car but just refuses to pay the sticker price. We saw analysts at Wells Fargo and Citizens lower their price targets.
Not because the company's doing badly.
No, but because they believe the price-to-growth rate is just out of whack. The market has suddenly decided that it wants justification, not just growth.
There's a shift from growth at all costs
to growth at a reasonable price. And the way the market enforces that is by punishing the stock until the price comes down to a level it's comfortable with.
And what's so wild is that this wasn't a one-off. We saw the exact same thing happen with Doximity, the health tech company.
Ticker DOCS.
Almost an identical paradox. They also hit a new 52-week low at $47.65.
And with Doximity, it's even more confusing. It is. Because this drop happened right after the company reported Q2 earnings and revenue that substantially beat Wall Street's expectations.
So they beat on the top and bottom line, and the stock went down to a new low.
Yes. Normally a beat like that sends a stock soaring. Instead, the market sold it off.
It just seems like investors have decided to completely ignore positive short-term news if they feel the long-term valuation is stretched.
So the lesson is, right now, just running your business well isn't enough to protect you from a negative sentiment wave.
It really isn't. But let's turn to a company that seems to have zero doubts about its own valuation. Hims&Hers.
Hims.
In the health tech space.
Yeah.
And they just made a really aggressive statement.
Oh, they did. Hims&Hers announced a brand new $250 million share repurchase program.
A new one? I thought they already had one.
They did. They just finished a $100 million program. This is on top of that. This is a massive, massive signal of confidence.
You're telling the market, we think our stock is undervalued, and we're willing to put $250 million behind that belief.
Precisely. And that confidence isn't just financial. It's also strategic. They made a key executive appointment.
Deb Otter.
Deb Otter, who was on their board, is now the company's first ever chief policy officer, the CPO.
Okay, a C-suite role just for policy seems like a big deal. Why is that suddenly so important for Hims?
Because of where they operate. They're at the intersection of tech, direct-to-consumer pharmacy, and very sensitive patient data.
Okay. Regulation.
All of it. As they scale globally, navigating compliance and public policy becomes a huge potential bottleneck. Creating a CPO role shows they're maturing. They understand that regulatory risk is now just as important as product risk.
It's a sign of long-term planning.
A key sign.
Now, moving over to real estate tech, things weren't as rosy for CoStar Group, CSGP.
No, they had a tougher day. Wells Fargo lowered its price target on them from $70 down to $60.
And they kept an underweight rating. What was the reason?
The main driver was increased competition in the rental market.
What kind of competition are we talking about? Startups? Or bigger players?
It's kind of both. The rental space is really fragmented. So you have the big established players like Zillow getting better with their data, but you also have these smaller, digitally native startups that are chipping away at CoStar's business in certain cities.
So Wells Fargo thinks CoStar might lose some of its pricing power.
That seemed to be the concern, yeah.
And while Zillow and Opendoor were quiet, we did get a positive note on one of their competitors, Compass, COMP.
We did. Investing.com put out a SWOT analysis. And they gave Compass a lot of credit for its resilience and for how well it's executing its strategy to grow market share, even in this really tough market.
All right, as we start to wrap this up, let's look at what's on deck. We have earnings today, November 18th, from BellRing Brands, BRBR.
And that one has been volatile. It hit a 52-week low just a few days ago. The analysts are all over the place ahead of the report.
Right. UBS is neutral, but then TD Cowen just lowered its target to $37.
It really sets the stage for a dramatic reaction one way or the other. We also saw some important, if routine, moves from big institutions.
In retail, right. Wayfair and Deckers Outdoor.
Both of them, Wayfair W and Deckers, DLOC, filed Schedule 13GA reports.
Okay, for anyone who doesn't live and breathe SEC filings, what does a 13GA tell us?
So a 13G is just a form that a large passive investor, like a mutual fund, files when they own more than 5% of a company. The A just means amendment.
So they change their position.
Exactly. It means a major fund has either bought a lot more or sold a lot of their stake. It's a subtle sign that big money is shifting around in those stocks.
And finally, we have to mention the quiet majority, the companies where nothing really happened.
Right. Teladoc, Roku, Fubo, Lemonade, Carvana.
InMode, Lovesac, Celsius, Oatly, Dutch Bros, a whole bunch of them.
Which is totally normal.
Yeah.
After a big earnings season, companies go into a quiet period. So, no news is often good news. If we connect this to the bigger picture, what the last 24 hours really gave us was a snapshot of what investors care about right now. We saw clean technical moves like the Netflix split. We saw these high-conviction strategic plays like the Affirm investment and that massive Hims&Hers buyback.
But the main story was that divergence.
That's the overwhelming narrative, the disconnect we saw in Part 3.
So to summarize for you, the listener, this snapshot isn't really about picking today's winners and losers. It's about recognizing the type of news that's actually moving the needle. You have to be able to tell the difference between a foundational corporate strategy, like Hims betting on itself, and what looks like a temporary but very aggressive wave of market sentiment punishing great growth stories like Duolingo.
Exactly.
So what does this all mean?
Well, given that we saw two very different companies, Duolingo and Doximity, both hit 52-week lows despite reporting really strong operational numbers, the question you have to ask yourself is this. Is the market permanently resetting its expectations? Is it going to keep punishing high-growth companies that can't provide a rock-solid near-term valuation story no matter how well they're actually running their business? This whole trend of value over velocity seems to be dominating everything right now.